And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
Good morning. Welcome to the show. It's, of course, Thursday as we get ready for the second best day of the week. Of course, wrapping up this week, heading into the end of August already. I mean, it's just amazing how fast things go by. Kids are all packing up, leaving for school. My daughter's upset. She starts school today. So she's like, I can't believe summer's over. Back to high school for her.
You know, starting school in August is unscriptural.
I know. You know, it's very interesting, like our whole street yesterday, you know, looked like a garage sale that was going on because all these cars are pulling up and I'm included, right? I mean, cars are pulling up into my driveway. I'm like hauling stuff out to the car, putting stuff in the car. Everything that we moved to our new house that we're renting, there's a lot of our furniture from old house didn't fit.
Right.
So the word got around all of our kids' friends. They're like, oh, I hear you have some bar stools you're not using. Can I have them? And so I was like, yeah, come get them. Yeah. So free labor.
No kidding.
But yeah, the whole street though yesterday, cars like packing up, getting ready to go.
It looks like a U-Haul convention.
Oh yeah, it was. So absolutely. But anyway, everybody's getting ready to go. Move-in day start today. Michael Leibowitz won't be joining us this morning as he usually does because he's down in Florida moving his son into college.
Yeah,
So University of Florida, go Gators. So anyway, a couple of things to talk about today, of course. The Federal Reserve yesterday out with their latest FOMC minutes. Now these were the minutes from the meeting they had in July. So now they released the minutes and we all kind of get to parse those now and try to, wrangle out what we expect out of them. Well, on the initial release yesterday, markets had been selling off yesterday morning a bit, had run right into the 200-day moving average, a lot of resistance there. Markets sold off a little bit yesterday morning. At the time of the release, and we'll go through some of what was said here in the next segment, but at the timing of the release, the markets actually rallied back almost to break even because on this kind of idea that, oh, look, the Fed might almost be done, right? We almost might be done hiking rates. And this has really been the focus of the markets here over the last 4 weeks now, this 4 or 5 week rally that we've had. It's been very good, very extended as we've talked about before. But the rally's been based on this idea that the Fed would stop hiking rates. Look, the Fed's going to stop hiking rates at some point. That's kind of just, logical. And they're eventually going to slow the pace of rate hikes. That's also logical. And so the markets are really kind of running way ahead of the game here. We're nowhere close to the Fed reducing their balance sheet. And as we talked about yesterday, cutting rates back to zero. Markets are right back to where they were in September of last year, exactly when the Fed was doing $120 billion a month in QE and zero interest rates. But now, very opposite. 2.25 interest rates, potentially going to 2.75 in September. Obviously, QT at $95 billion a month, not QE of $120 billion. So it's very interesting. Markets are rallying as if it's 2021 again. But the backdrop to the environment is, of course, very, very different. Economic data out yesterday showing some slight upticks, right? Retail sales coming in a little bit better than expected. Again, be careful with that number. Simply means that people are paying more for less stuff, right? So we measure retail sales in dollar volumes. Now, the one takeaway yesterday was that people saw an uptick in demand in gasoline purchases as prices declined at the pump. So people started driving a little bit more. but there was a decline in the price of gasoline. Saw demand pick up a bit, but retail sales generally, general merchandise, construction, building materials, of course, people get ready to go back to school, buying stuff, renting U-Hauls, all that. So as we talked about before, there's a really good possibility that we're going to see that second quarter negative GDP number get revised up into a positive number, be just slightly positive, 0.1, 0.2% growth. And very likely that quarter three could actually show some positive growth here, maybe around 1%-ish. Again, very weak economic growth, but still positive. And this is because, as we've talked about before, all the rate hikes that the Fed's been doing since the beginning of the year have not shown up in the economy yet. And that was something they actually mentioned yesterday in their minutes, that there's a lag effect to monetary policy, and they're right. It takes about 9 months for a rate hike to show up in the economy. So the rate hike they did in July of 75 basis points won't show up until March of next year. So that's why the real risk of an economic slowdown, i.e. contraction/recession, is really more of a 2023 probability than it is a 2022 probability. Too many twos in there. So this is kind of one thing we've talked about before. What happened in the first 2 quarters of this year, likely a correction. This rebound rally, not too surprising here. Again, we had very, very negative pessimism in the markets. And again, very interesting, global fund managers, as an example, their view of economic growth was as low as it was at the depths of the financial crisis in 2008. Now, that's slightly improved here over the last couple of weeks. But again, that's what I'm talking about. This negative sentiment we had, despite this correction only being about 18, 19% on the S&P. And again, still well above where we were at the peak of the market in 2020. So, there's not been a lot of destruction of capital over the course of the last several months. But despite that, people's view of the markets was as if we just went through a financial crisis. I'd written an article about this. It's like, did we just go through a major bear market? Because that was the view. The sentiment was so negative. It was like we'd just been through a disastrous bear market of a 50% decline, because that's how investors viewed the market. And that deep negative sentiment, as we talked about before, is what provided that catalyst for this boost. Now, interestingly enough, everybody's well back into the bullish camp, right? Reddit traders are now back, right? And they are back buying option strategies, running up meme stocks over the last few weeks. They're back in action. I've got a story about a 20-year-old kid that made $100 million in 3 weeks. 20 years old. So we'll talk about, that's just, I'm looking at my son going, why couldn't you do that?
Bet he's not going back to college.
Exactly. So he's set for life. Anyway, we'll get into all this morning, of course. One thing to really kind of pay attention to here, our overbought technical signals are starting to, tighten up here a bit, getting closer and closer to a sell signal. We're going to get a sell signal in the markets in the course of just the next week or 2 or 3. Potentially seeing a weaker September wouldn't be surprising. Potentially have a down month. Again, just these signals have gone a long ways. They're now getting very tight here, starting to constrict. And again, we are going to get a sell signal at some point here. We just don't have one yet. So again, no reason to be overly concerned right now, but certainly looks to be a time right here where you want to start taking some profits, reducing some risk, kind of rebalancing your portfolio a bit. You'll have an opportunity, again, on a pullback towards the 50-day moving average is going to be probably one of your better opportunities to put some capital back to work, increase your equity exposure there as well. But again, kind of need to go through this market cycle that we're in. Again, very, very good bullish run that we've had, a little bit overdone here, so a bit of a profit taking won't be surprising. When we come back from the break, though, we'll kind of dig into what the FOMC said yesterday. They did make some interesting comments. Talk about what that might mean for the markets going forward and what really the Fed may be doing. Again, also coming up at the end of the month, we have Jackson Hole. That's the big symposium. We're going to get a lot of Fed speakers out. And then, of course, the September meeting of the Fed in terms of their next rate hike coming up. So we got a lot of stuff with the Fed coming up over the next month or so that will certainly impact markets. Quick break, be right back. Get by the website, realinvestmentadvice.com. I've already published a daily commentary this morning. Click that link. Get it now. Be right back after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
Could your job still be at risk? A new normal can still include new obstacles. A severance package can be an emotional as well as a financial decision to consider. Wouldn't it be comforting to review the options for you and your family with an objective financial partner? At RIA Advisors, we're here to help. From severance pay, tax timing decisions, to how to maximize unemployment benefits, the RIA team wants to make sure you can do what's best for your family. There's no charge for a consultation, so reach out to RIA Advisors, 855-RIA-PLAN, RIAadvisors.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Did you know that the word incorrectly is only spelled incorrectly when you spell it incorrectly?
Yes.
One of those things you have to think about.
I'd like to buy a vowel Vanna.
Exactly. The spelling of wife. Husband is silent. Yes. That is a true statement.
Yes.
I see you're getting onto Danny's dad joke list now. Is this a new trend that you and Richard are tagging onto?
I think we have an infestation.
I think we need to kill that pretty quick. Considering I saw Danny's dead joke list yesterday in his notebook. So
he has an actual list?
He has a list.
Oh. Thank you for the warning.
Yes. Okay. Speaking of dad jokes, FOMC out yesterday with their Goldilocks scenario, kind of the Goldilocks three bears. Something a little bit for everybody yesterday. Not too hot, not too cold. Kind of what you expected. Again, these minutes are crafted for release. These are not the actual minutes of the conversations that they're having. These are the quote-unquote minutes that, again, they carefully craft for the release so that it doesn't spook markets and, politicians, etc. But again, there was, quite a few things kind of for everybody, whether you're looking for that dovish tilt or for a hawkish tilt, depending on how you feel about the markets. There was a little bit there for pretty much everyone. Fed officials judged moving to a restrictive stance was required. Now, what does that mean? So we're talking about restrictive monetary policy. So in other words, I've got to hike rates and tighten the balance sheet to where I constrict the monetary supply to the markets. That is intended to slow economic growth, which will then quail inflation. So I want to make things too expensive for you in terms of borrowing money. I want to slow that demand of borrowed capital. So you'll stop spending as much, and then that will slow economic demand. As demand falls, then companies like Target, et cetera, start liquidating inventories like we saw yesterday. Consumption slows, people get laid off, so you have unemployment. and then that slows the economy, right? And as the economy slows, that drop in demand leads to slower inflation. So that's what they're talking about by a more restrictive stance is required. So that right there tells you they're going to keep hiking rates. Inflation was unacceptably high, and inflationary pressures are broad-based. The officials also judged that the bulk of tightening effect was yet to be felt. So two things here, kind of a contrarian stance on that. So one side of this is that inflationary pressures are too high, so for the hawks are going, aha, see, they've got to raise rates more. Got to hike rates more because inflation's too high. They've got to tighten that monetary policy, hawkish. The doves go, hey, yeah, but wait. This is where we need the soundtrack from the man formerly known as Prince, When Doves Fly. Judged by the bulk of the tightening effect yet to be felt. So the doves are going, hey, well, what that means is they've already hiked a bunch here. We're at 2.25%, and they may pause or stop hiking rates here because they don't want to over tighten because the bulk of the rate hike effects they've done so far have not been felt in the economy yet, which is a true statement. So lower commodity prices, of course, leading to a decline in inflationary pressures. Wheat, as an example, basically crashed as Ukraine shipments have gotten back online. I told you this would be the case. You remember back earlier this year, everybody was jumping into commodities with both feet. You know, I got to buy agricultural and food and all this stuff because it's going to the moon and it's never coming back down again. And we're like, whoa, just be careful here. One-sided bets tend not to work out well. End of the world stuff never works out well. And we've had a big reversal, right? Oil prices have not come down. Food prices are dropping sharply, etc. Not surprising. It's the way it works. The playing down of lower commodity prices are cooling inflation was also another kind of statement buried within that FOMC minute release that, you know, really kind of picked up on the doves' ears yesterday. So again, like I said, a little bit of something for everybody. And really kind of the come away with that is the committee could tighten the stance of policy by more than necessary to restore price stability. Again, hawkish statement, right? But then they follow that with they saw a slower pace of rate hikes at some point. Doves, see a pivot's coming. So again, something for everybody all through this statement. And that really kind of left markets hanging in limbo yesterday. So again, right after that initial release, when the minutes came out, the markets rallied back almost to break even. And by the time the market started digesting it a bit, sold off a little bit into the close. Now this morning, futures are mildly up. We're up about 4 points on the S&P. Dow's up about 41 points. So no big moment here. The big thing is the markets are pushing up on that 200-day moving average. We're very extended, two standard deviations above the 50. We talked about just it's technical mumbo jumbo, but just we're very extended here. And you typically get a pullback of some sort. Just markets need a respite here after such a strong rally. You kind of think we've used the analogy of a car with a tank of gas previously here on the show. Of course, in Houston, sometimes it'd be better if you had a tank. But when the car is going, it's got a full tank of gas when, everything is very bearish. And we were extremely bearish back in June, July. Now we've pretty much used up that tank of gas. And so now we're starting to look for a gas station to refill. Well, in order to refill the gas tank, because we're not the Air Force and don't have, fuel planes flying around filling us midair, we have to pull over and stop. So that's what the markets are going to do. The markets have to pull over and stop here for a little bit, refill the tank before the next run. So again, this is what I was talking about just a few minutes ago. Probably a good time. Take a few profits, rebalance your portfolio risk, look for a better entry point, when we get there. Just going through some of the other notes here, I thought it was interesting. Several of the participants who commented on issues related to financial stability noted that, on balance, asset valuations had eased from elevated levels in recent months. That is true. They've reduced from elevated levels to less elevated levels. They're still elevated, We're still at 30 times earnings. They're just not 36 times earnings anymore. A few participants mentioned the need to strengthen the oversight and regulation of certain types of non-bank financial institutions. That also rolls over into cryptocurrency, and particularly like companies like Coinbase and financial, endeavors in the cryptocurrency space, exchanges, those type of things. Participants generally judge that the bulk of the effects on real activity had yet to be felt because of the lag effect associated with transmission of policy, and that while moderation in economic growth should support a return of inflation to 2%, and I like the word moderation, that's the polite term for recession, kind of like, high yield is a polite term for junk bonds. The effects of policy firming on consumer prices were not yet apparent in the data, and that's true. That's still got to come. And one thing is interesting here, too, that is causing a problem for the Fed. If you take a look at financial conditions, those have actually eased fairly sharply here over the course of the last 4 weeks. So what the Fed is trying to do is they're trying to tighten financial conditions, and yet the market is trying to anticipate the next leg of financial instability by running up prices and hoping for that Fed pivot. And yet it's causing financial conditions to ease, which is going to make the Federal Reserve have to actually tighten interest rates more to get the effect that they want in the economy. So it's kind of interesting that the market's working against what the Fed is actually trying to achieve. On rates, all participants agreed that 75 basis point interest rate was appropriate this was the July meeting. Many officials saw the Fed could tighten more than necessary. Some participants said policy rates would have to reach a sufficiently restrictive level to control inflation and remain there for some time. So in other words, hike rates and leave them there for a while. That's not really great for the economy, by the way. Participants concurred future rate hikes would depend on incoming information. And what that suggested and what the markets took immediately, and if you were watching the Treasury rates yesterday, they immediately dropped. Fed funds futures went from a 75 basis, almost a certainty of a 75 basis point hike in September to a 50 basis point hike on that statement in just seconds. So right now there's almost a certainty of just a 50 basis point hike because of this statement that incoming information, which recently saw inflation slow down a bit, they're expecting now that the Fed will only hike 50 basis points in September rather than 75. On inflation, participants agreed there was little evidence that inflation pressures were subsiding and it would take considerable time for the situation to be resolved. Certainly doesn't sound dovish. Participants emphasized that slowdown in demand would play an important role in reducing inflation. Okay, that's not great for markets. Now, reduction in demand, we just saw this with Target's reports yesterday, having to slash prices to get that inventory moved out because slower foot traffic, right, impacted their profit margins. And so when we talk about what we're paying for, right, so now we're investing in stocks, what we're buying is a future stream of cash flows and earnings. Those are all going to slow down more over the course of the next several months as they continue to fight this inflation fight, which suggests that stocks are still overpriced relative to what's coming. So again, just some things to think about. Anyway, lots of stuff in there. I'll be touching on this some more in our newsletter this weekend on our new Bull Bear Report. That'll be out on Saturday. Make sure you're subscribed at the website for the newsletter. We'll have that out for you on Saturday. Like I said, get you up to date on the markets, all of our positioning, trading, everything we've done this week. They'll all be in the newsletter for you. Be right back after the break. You can get subscribed at realinvestmentadvice.com right now for free. Go do it now on the break. We'll be right back.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Let's be honest. Me and Brant, we're here whether it's sickness or injury.
Without fail.
Without fail. Danny gets a little sniffle and he's at home all curled up with his blankie.
Well, he's got all those Petri dishes on legs running around his house.
You know what, though? But I had that. You know what happens? Your immune system gets a lot stronger.
The Real Investment Show podcast. Same show, your schedule.
Drink out of the garden hose.
At realinvestmentadvice.com.
That was the best water.
It was. It's not great for you, but...
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the insurance tab.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
Have market gyrations caused you to lose sleep? If so, it's because you have more risk in your portfolio than you realize. It's time to reevaluate your long-term investing strategy with RIA Advisors. Our disciplined approach can help eliminate unnecessary risk. If you think it's time to work with an advisor who puts your interests first, it's time for Real Investment Advice. RIAadvisors.com.
You're listening to The Real Investment Show.
Welcome back to the show this morning. So Brent always puts interesting stuff on my notes page from time to time, and he put one up this morning. A new study says ice cream might be healthier than a multi-grain bagel.
Yes.
Yes. You know, just take a scoop of vanilla ice cream, throw it in your coffee.
Oh, man, yeah, that's good.
Just go on about life, right?
It's larapin good.
You know, it's interesting, though, because... You know, you got to be careful with this. And we talk a lot about health and fitness on the show because, as we've talked about before, you know, your health is so important to your financial outcome down the road. You know, when you take a look at society in general, we're very overweight and you know, not healthy in general because of the food that we eat and the things that we do. And so this leads up to a problem later on in life where we spend a lot of time on medical bills and in hospitals, and not really a great way to spend retirement, right? You know, everybody dreams of the retirements. You know, they show the Morgan Stanley commercials on television where it's the old couple sitting on, you know, I shouldn't say old couple because I'm there. It's the older couple, you know, holding hands or sitting on the beach. I love the one. It was a Morgan Stanley. I think it was a Morgan Stanley commercial a few years back, and shows this couple. They're sitting in what do they call it? Adirondack chairs.
If you hadn't have said that,
I know I can never pronounce it correctly. Klondike chairs, whatever.
Wooden chairs that fold.
Yes, those chairs.
Yes.
I think they're called Klondike.
Adirondack.
Yeah, Klondike chairs. Have an ice cream bar and a chair. Anyway, however you pronounce it, they're sitting in these two chairs on the beach, and they're, and then the camera kind of rolls over, and there's a third person there, and it's their financial advisor sitting on the beach with them.
In a suit
on the beach,
Yeah.
Retired. And this looks great, right? This is what we dream of as being part of our retirement. The problem is that reality is that a lot of people, instead of sitting on the beach, they're in and out of hospitals constantly, and having to deal with health issues and all this, because we just don't make better choices. And we talked about on the show before, make better bad choices now, and it pays off later. And it's interesting when you talk about, that ice cream could be healthier than a multigrain bagel, and you kind of go, well, that doesn't make any sense at all. I mean, ice cream is ice cream. We've always been told that's bad for us. Bill Cosby, before he went haywire, he had a whole skit about feeding his kids chocolate cake for breakfast, and the wife gets upset with him, and he's like, honey, it's flour, it's eggs, it's milk, it's a complete nutritious breakfast. It's just in the form of chocolate cake. And there's not a terrible, it sounds like a terrible idea, but when you go to a restaurant, you've got to be careful. And again, we often think about food in terms of a measure of, that's bad because it's a cheeseburger. Right? Can't have a cheeseburger. I've been told cheeseburgers are bad for me, so I'm going to have a salad instead. Be careful with that, because if you look at menus, and now because of the new nutritional guidelines, all these restaurants, if they have more than 15 locations, they have to actually put the caloric count on the menu. And in a lot of cases, that cheeseburger has less calories than the salad. So losing weight is about caloric deficit. So if you need 1,500 to 1,800 calories a day and you want to lose weight, cut that caloric intake by 300 calories and you'll lose weight. That's just how it works, right? Your body's a machine. You just have to feed it appropriately. Now, I'm not saying you should eat cheeseburgers every day versus a salad. I'm not saying that at all. But all I'm saying is that just because we've been told that certain things are bad for us doesn't necessarily mean they are. And so there's kind of an interesting take on this ice cream versus a bagel, because it also depends on what goes into the bagel.
That's right.
Yeah.
Slap all that cheese and butter on it.
Einstein Brothers.
Skyrockets.
Einstein Brothers bagels is terrible.
It's good stuff,
It's
Maynard.
terrible. Cannot go into that store at all. There was a story a while back about this Seattle CEO, and this is, you remember back, we've written some articles about the fallacy of the $15 hour minimum wage, and there's a series on TikTok that I was showing Danny yesterday. It's called Gen X Talks, and this son, I would love to play some clips for you on the show, but I can't, because the father drops the F-bomb quite often. As a Gen X does. But his son goes in and asks him, questions about, hey, I don't understand, this or that, about how you Gen X people think versus millennials. And he makes just, and the father just lays it out clearly as it is. And, it's talking about everything from online dating to, whatever. Well, his son goes in and talks to his dad. He says, Dad, when I don't really see the need to go to college, because if I get an entry-level position out of college, then I can't afford to buy a house or buy a car. And he says, look, if you get an entry-level job, you're going to have an entry-level life. That's the way it works. And then you work hard, you do your job, you get promoted, you make more money, and then you can afford more things. And he's like, well, Dad, what about the guy that works at McDonald's, has 3 kids, and his father says, he's working on something in the garage, he kind of throws it on the table, and he's like, what guy has 3 kids and gets an entry-level job at McDonald's? That's like saying, I went home, I had sex with my wife, I have kids, and now I deserve more money, right? Because I have kids? That makes no sense whatsoever. What does that have to do with life? And this was that whole debate over this $15 an hour minimum wage, which is, I need to have this minimum $15. I need to have this livable wage, right, to work. I should be entitled to that. And as we've talked about before, your minimum wage is 0. You are not entitled to anything. What you get paid for is the skill set and work ethic you bring to the workplace. And that's what determines your compensation. And what entry-level jobs are for is it's a testing ground for you and for the employer to say, hey, are you going to be good for this job or not? Can you flip a hamburger and sweep a floor? If you can do that, I'll pay you. And then if you show some gumption, I'm going to move you up to assistant manager, so forth and so on. You're going to get elevated through the ladder. The number of people making minimum wage in this country is about 3 million out of 130 million employees. So very few people make minimum wage, even though this is the crux of this. So anyway, so the long story short of this is we've written articles, we've talked about the fallacy of the minimum wage. And there was a CEO in Seattle made headlines, and this was back in 2015 when all this was kind of running around. He said, my number one priority is for employees to work their best in the company world, and my presence has become a distraction because he was making too much money. So he cut his salary so he could pay all of his employees $70,000 a year. And everybody was like, this is genius. Genius, right? Here's a CEO doing right by his employees. I'll read to you from the story. Seattle CEO announced in 2015 he was giving himself a drastic pay cut to help cover the cost of big raises for employees, has now announced his resignation. Dan Price, the embattled CEO of credit card processing company Gravity Payments, has resigned on Wednesday, Seattle Times reported. Price stunned the 100-plus workers when he told them he was cutting his roughly $1 million to $70,000 a year and using company profits to ensure everybody would earn at least that much within the next 3 years. Well, the problem is that it didn't really work out that well. And now he's resigning, of course. And again, it's not surprising. You have to run a company for profitability, and that doesn't mean that you can just willy-nilly just pay everybody more money, because if the company's not making money to cover those salaries, somebody's losing a job, period. And this is why companies don't do that. Look, there is a level of skill that employers need in order to operate and run a business. And that's what determines your salary, your income, et cetera. And so, again, where people, get misled, and this is one of the big problems, and we all talk about, hey, we need to bring semiconductor manufacturing back to America. Sounds great, right? Sounds fantastic. Let's do this. Let's pass a $50 billion bill to bring, or actually $250 billion bill actually altogether with incentives, to bring semiconductor manufacturing. Let's onshore that stuff right here in America so we don't have to worry about supply chain issues. The problem is you can't afford it, because everybody freaking wants $15 an hour minimum wage or be paid some astronomical salary. Plus they want, on top of that, healthcare benefits, paid time off, paid leave, family leave, sick leave, personal time off, healthcare benefits, 401k plan, contribute. They want all this stuff, right, on top of the salary. That's all got to get put into the cost of the product you're making. And so companies go, I can't sell it for that. People aren't going to pay $10,000 for a laptop. They'll pay $500. So I can't afford to have semiconductors made in the U.S. where they cost too much. I've got to impute all those costs into the profitability of the chip. While we're talking about this, I thought it was interesting to the same point. Apple just announced that they're moving their production not back to the United States, having to move it to Vietnam because they need cheap labor. Be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So, yes, just for the break, talk a little bit about offshoring and the cost of salaries and this type of thing. And the new trend is no longer called offshoring. That is politically incorrect because we shouldn't offshore. We should friend shore companies. This is the new term. So companies are now going to be friend shoring.
That's as convoluted as social distancing.
Correct. AirPods, Apple Watch, HomePod, and more. Apple has big plans in Vietnam, apart from iPhone manufacturing, which they've already moved to Vietnam. This is from the Nikkei Asia yesterday, and this is exactly to the point. Now, why does Apple have big plans in Vietnam versus China? Remember the whole Foxconn story in China where people were jumping out of windows? They work for $2 an hour. And they just work them 20 hours a day until they literally jump out of windows at the manufacturing plant because they're overworked, stress. So they're moving from China on the manufacturing to Vietnam. Big win for Southeast Asia. Why? The trend is called, I'm going to read to you from a story. This was in Nikkei Asia. The trend is called friendshoring. While it's a play on offshoring, this isn't about companies moving operations back to the U.S. and Europe, right? So we're not bringing these jobs back to America, ladies and gentlemen. Why? Can't afford it. Exactly what I said in the last segment. You know, you think an iPhone's expensive now at $2,000 or whatever it is to buy an iPhone. Wait until you bring it back and manufacture it in the U.S. We export inflation to import deflation through cheaper products. The trend is called friendshoring. While it's a play on offshoring, this isn't about companies moving operations back to the U.S. and Europe, but rather seeking foreign alternatives that retain the benefit of what? Low labor cost, but with less international controversy. Nobody's picking on Vietnam. We've already done that fight. Taiwan's still coming. Apple's production diversification comes as the U.S. and China already had an increasingly adversarial relationship. Of course, also remember the Trump tariffs, increasing the cost on products coming in from China. That was before House Speaker Nancy Pelosi visited Taiwan, sparking anger with Beijing. The fact is that geopolitical and trade war tensions aren't going away anytime soon and will only push Apple further away from China. Though reshoring production in the U.S., here's the key sentence, the reshoring of production to the U.S. is unfeasible because of labor cost in general. Exactly what we said. Maybe robotics can offset some of those costs, or perhaps set up shop in Mexico, where there's an abundant supply of cheap labor and healthy demographics. Now, think about that for a moment. How does that help create stronger economic growth? And this is the whole fallacy of the political paradigm right now all across the U.S., which is everybody deserves a livable wage. Everybody deserves this. We need to pass a bill in Congress where we run up our debt some more to give people paid time off, family leave, sick leave, whatever it is. We're trying to figure out ways to give people more money. The employees are all going, I want more. If you want to hire me, great, I'll come work for you. And, but you've got to pay me. And kind of to the point of Gen X talks, when I graduate college, I'm expecting $70, $80, $90, $100,000 a year so I can immediately go out and buy a big house and a fancy car and I can live the lifestyle of all these people I see on TikTok. That's not the way the world works. Only in America do we have this very distorted view of what getting by seems like. In the U.S., if you make $30,000 a year, you're in the top 1% of income earners worldwide. You should be thankful. But no, we're not. We're upset because we can't afford the big house, the fancy cars, and we don't have what the billionaires have, and we're all jealous about that. So we need to take more money from them and give it to somebody else, which doesn't help the situation at all. If you want a stronger economic environment, you have to do three things. One, stop doing things that keep you from having kids because you need a demographic growth trend inside the economy. The second thing you need to do is start working for a living and getting back to the things that actually produce and manufacture goods and services. And three, quit demanding more than what you're worth. But see, we don't want to do that. When your pipe busts in your house, you will pay a plumber just about anything to have him come fix it. There's an established worth with a plumber, an electrician, carpenter, tradesman, period, right? When you need something fixed, they can pretty much charge you whatever they want. That's a fair and honest wage, driven by supply and demand. The less supply of those tradesmen that you have, the higher those costs are going to go. And if you think inflation is high now, wait until you start running out of plumbers, laborers, and tradesmen to do work. We're all spending our time sending our kids to college going, oh, it's okay, get a sociology degree, get a history degree, whatever. Get the easy degree. Just get your degree and get out. It really doesn't matter. It matters, ladies and gentlemen, what degree your kids get in college, because that will determine what companies will pay them in the future. We talk about the gender, there's all this talk about the gender wage pay gap. They did a study just recently and they found out that why do women get paid less than men? Because they choose careers that have lower salaries than men do. There's not really a wage pay gap. It's just the choices that we make that lead to the gap in wages between men and women. See, we never get to that point, right? We just look at the headlines. We just look at how much did women make last year? How much did men make? We don't say, well, why did women earn less than men last year? What was the choices that they made on the degrees they get? Their degrees primarily in areas that have lower wages, right? Teachers, nurses, those type of things. Not everyone. We're talking about on average, right? Men, they make bad choices too, no doubt about it, but more men are involved in things like mathematics, engineering, etc. That's just a function. Go to colleges and look at the number of degrees of people that are in certain degrees that companies want to hire. Take a look at the companies. They say, what are the top 10 degrees that you want to hire people with? I want mathematics, engineering, computer sciences, accounting, finance, those type of things. Those are your top 10 degrees that companies right now are looking to hire for, and they are willing to pay for those jobs. If you have a degree in computer engineering, automation, robotics, they will hire you in a heartbeat because there's not enough people out there that have those degrees, and they will pay you well. Those 10 degrees are the least populated among all the degrees taken in universities. Degrees like sociology, psychology, history, government, politics, those type of things. Those are the 10 most populated degrees by students in universities, and those are the 10 least wanted degrees by companies. How do you think that works out when they go out to get a job? Yes, they've got a degree. That's awesome, and they've paid $100,000 for that degree. What do you think it gets them in the workplace? Again, what's your salary determination? It's what you bring to the job. Your skill set, your talent, and your work ethic. And your work ethic is not showing up at 10 o'clock in the morning and wanting to go home at 2 and working 2 days a week in the office. Sorry, you got me off on a rant this morning. Anyway, the point is, this is why we have inflation, and this is why ultimately we're going to have more problems down the road, is because companies can't onshore labor. It's too costly. We want too much. Eventually, either we outsource more labor and we have slower economic growth and a lower standard of living here, which eventually will lower the standard of living and the demand for salary enough that it brings manufacturing back to the U.S., or it doesn't. You know, we all look back at the 50s and the 60s when the economy in the U.S. was booming, hand over fist, growing at 8% growth rates, wages were high, debt was low. You got to remember, we were almost entirely blue-collar manufacturing. We had devastated Europe and Germany and Japan and Russia. It had all been wiped out during World War II. We were the sole manufacturing powerhouse of the entire world, and we manufactured everything here to rebuild all those countries. Blue-collar labor was it. Has huge input costs, huge multiplier effects in the economy. Wealth was very broad in the U.S. We had a very broad manufacturing and middle class in America, and America was strong. And we all look back to that and we all go, man, could we have that again in the U.S.? Yes, we can, but we have to change our thought process. You go back and look at the boomers, my parents, your parents. How did they live? They lived in 1,100 square foot houses. Cars cost $6,000. They weren't fancy, right? They were basically metal boxes on wheels. But it got you from point A to point B. No debt, paid with checkbooks, spent their time working, reading, educating, because they didn't have iPhones and laptops to stare at all day. I'm going to save this story for next week. Just tease you with it. Study claims more kids are fat and unhealthy because of global warming. That's another rant topic coming up for next week. It ain't global warming, ladies and gentlemen. But I'll tell you what the real reason is next week. Anyway, Richard Rosso, Danny Ratliff back here tomorrow for Financial Fitness Friday. Stay tuned. Our 3 minutes on markets are coming up. Our daily market commentary is out. So be sure and get by the website, realinvestmentadvice.com. Sign up for our daily morning commentary. It comes out to you every morning, but right at 7:30 on the nose. You'll get an email getting you set up for the day, talking about our market update, trading updates, get you updated on what the markets are doing, economics, earnings data, all that there for you. It's free. All you got to do is sign up at the website, realinvestmentadvice.com. So click the button below, like this video, get an alert, go get an email. See you tomorrow.